Sean Peche, Ranmore Fund Management founder. Sean, after about a week of consolidation, we've seen huge sell-offs yet again in some of the big growth names in the US. Meta, PayPal, Spotify, to name a few. Let's start with Facebook, or Meta rather. One of the FANGs, a big component of the US indices, therefore big exposure to all passive investors. This is something that you've noted, one of the large risks about being passive for a while now. But before we get into that, what were the main drivers for a 22% sell-off in after-hours trade?
Yeah, thanks, Justin. Look, it was a big move, and I think more than just the percentages, because 20%, it sounds big, but I think the problem is these companies are absolute giants. And if you look at Facebook, I mean, it's fell $200 billion after hours, so we haven't even seen that wiped out from investors' savings. PayPal lost 50 billion the day before, 200 billion since July. Netflix 65 billion last week. Tesla 100 billion. So these are massive numbers, and they are really hitting investors, and investors are going to find that out in the next fact sheet. So, and the problem is, so what drove it? Well, there are a few factors. The one is that these companies are so large. I mean, if you think that there are 7.8 billion people on the planet, and you take out China, and you take out the very young, and you take out the very old, Facebook, with their 2.9 billion users, it's pretty saturated. And look at the daily number of users in every region, pretty much every region, it's flatlined or down. And that's slowing users. Now, then think about how much time those users are spending on the platform. I mean, I don't know about you, but I'm spending less time on Facebook than I did a few years ago. And my children aren't spending any time on Facebook. It's all Snapchat and TikTok. So, the problem is these companies are just so big. And just to give you an idea, I mean, Apple grew revenue 11%. Amazing. Okay, but they offered no guidance. Apple's, it's a megalodon. Their revenue in the quarter was 124 billion. That is 6 times Procter and Gamble's quarterly revenue. And if you look at just their growth, their 12 billion that they grew by is twice McDonald's entire quarterly revenue. So how on earth do you grow off that? And you can bet on this growth continuing. You can be my guest, but Facebook and PayPal should be a warning as to what happens when it stops. So I think that's the first. That's the first point. The second point is, there's been structural change, and it's interesting because advertisers can't get access to the underlying users because Apple has changed their iOS availability in terms of what allowing people like Facebook to get access to the underlying users. And what surprises me is Zuckerberg's been telling everybody about this, and they even spoke about it at length last quarter. And I don't know whether it's all because so much money is held by passive funds or the short sellers have been blown out of the water. But I find it just staggering that people are surprised by this. And 84% of brokers still rate Facebook a buy. So, so I think that's the next point. Inflation, that's another problem. And you might think, I mean, it wasn't long ago when all the fund managers out there were saying, don't worry about inflation. All you got to do is be in great companies and they can pass on inflation. Of course, what Facebook said to us last night, or Meta, is that their customers are being affected by inflation. And when you look at the likes of Procter and Gamble, which had sales up 6%, but it had cost of sales up 16%, how do they make up for that cost of sales? Well, they have to try and do that from SG&A, and part of that is advertising. And so if you've got less advertising money to spend, and you now have more options because you've got Snapchat and you've got TikTok and you've got Pinterest and all these, and Etsy and all these guys, well, you're going to spread it around. And so inflation is affecting these companies indirectly. And of course, we've got Amazon tonight. And last quarter, Amazon was complaining about steel prices because that's what they build their warehouses with. And what do their vehicles use? Their vehicles use fuel. And what about the wage inflation that they were out there scurrying around when everybody was ordering stuff online, and they were paying top dollar for their employees? And there's always a bit of a lag because you're not giving them a wage increase and it comes through. So I wouldn't hold my breath for Amazon tonight. And every single analyst of the 59 broker analysts rate Amazon a buy. So,
Sean, this is something that you've been talking passionate about for at least the last year, the active versus passive debate. Passive is known as the safe haven. You invest in the indices and the indices only go up. However, of late, these big, large caps, there's a concentration risk that is attached to the indices. Do you just want to talk about that a little bit
Yeah,
more?
absolutely, Justin. And the problem is, this is an issue. It doesn't just affect the people who are living in California. You look at how much money South Africans have taken out overseas, either directly or have invested directly into feeder funds in South Africa. It's been a tricky time because, as I've said before, the wind's been blowing in one direction for 14 years. And there are very few funds out there that don't own these large companies, very few, because it's been a career risk not to. Things have just been getting better, and the P's just been going up, and interest rates have been low, and it's been really hard. And even finding value funds that call themselves value, that purport to be value, who have capitulated and own these companies. And that's often the sign that you're at the turning point. We have none. We have 7-8% in technology, and I'm happy to talk about which one and why. And the problem is, so these it's not just the direct funds, and they've gone offshore and bought passive funds. And the thing with passive funds is, I guess you save a few basis points on the fees, but who's happy about having saved 30 basis points or whatever the number is when you're staring into the abyss with these large companies that are down by these numbers? So I think it's a case of everybody's been sitting at the restaurant ordering very expensive bottles of wine, and because quality costs, and now the bill's arrived and everyone's rushing off to the bathroom trying to avoid having to pay it. But the bill needs to be paid, and it's been paid. And it's not being paid by value investors, I can tell you that.
Zuckerberg has cited the metaverse as the next big growth driver for Facebook. What exactly is the metaverse, Sean? I've struggled to get my head around it, and I don't completely understand. That's why I'm
Well,
coming to you.
hopefully you're in good company then, Justin, because what was the image? It's some imaginary thing that you go surfing with Mark. I don't know, to be honest. And it's supposedly the next big thing that's been driving but I'm the wrong guy to ask. And unless it makes money, I'm not interested. And right now, it's still at the investing stage. And what do they talk about technology? They don't talk about the leading edge. They talk about the bleeding edge. So we'll wait until that's further down the line. But there's going to be a land. If it is a big thing, there's going to be a land grab. And they're not the only people who are going to be competing for that space.
Sean, something that is close to your heart, valuation. The sell-off means Meta is now trading on a price to earnings of 17 times. That's not overly demanding.
Well, I don't believe that. To be honest, that's a forecast, and let's just look at how bad this could go. Okay, so there's a couple of points here. You look at the youth of today. What do they spend time on? They spend time on Snapchat, and Snapchat's market cap is 52 billion. Meta's is 700 billion after the fall. Okay. The second point I'd also make is that a lot of investors out there talk to free cash flow yields. And with free cash flow yields, you add back stock-based compensation. So that's the big thing, because they say, well, we don't pay our staff, staff cash and the share options. But then what they have to do is they have to buy back those shares from once those options have been exercised. And that consumes a huge amount of free cash. And it's quite interesting. Tesla's shares are up 5% in the last year because of all the share options that have been exercised. Snapchats are up 22% in the last 3 years. Microsoft spent half their money last quarter on buying back stock just to offset the share option dilution. PayPal spent 80% of the cash flow that they say they generated. It's about 100% of the cash flow I think they generated, just buying back shares to offset the dilution. So all this cash flow that these companies are generating is actually not going to shareholders in the form of dividends. It's not going to companies to reduce the shares out there. It's going to pay employees indirectly. And so I don't think they're cheap. And I don't think, 17 times earnings. Who knows? Just to give you an idea, we've got Hewlett Packard. It's our second largest position. And if you look at what Microsoft's been saying and AMD have been saying, the PC market is really strong. Okay, so they've grown earnings 67% over the last year. There's fewer PC manufacturers and printer manufacturers now than there were a few years ago. Chip shortages actually give them pricing power because they sell the most expensive components, but it's on 9 times earnings. And it's a $40 billion company. So don't buy a passive index thinking you're going to get big exposure to Hewlett Packard. You're not. And the other important thing is they've bought back 30% of their shares in the last 3 years. So, if you want exposure to these dynamics and these growth dynamics, you don't have to get it via the big companies, and you're not going to get it via the big indices. You're only going to get it from active value.
Sean, I'm talking Netflix, Meta, and PayPal now. Let's put them in a basket. All mega caps, all hit by 20 to 25% following earnings. But Sean, this hasn't got anything to do with earnings or earnings misses, or it does somewhat. Is this more of a culmination of all macro and micro headwinds coming together
Yeah, I
at
think
once?
that's well put, actually. I mean, if you look at those companies together, they add up to about 5.5% of the index. Okay, that is 50% more than the weighting in all energy companies in the index. And Exxon released their results the other day. It went up 7% 2 days ago. So, you can just see everybody's on the wrong side of the seesaw. I've mentioned this a few times. And I think you're getting inflation, valuation, slowing growth, investor concentration. And I put a LinkedIn and a tweet out this morning. And if people can't find it, by all means, have a look. There's a great interview with Jeremy Grantham, which I think it's 37 minutes. It's 37 minutes well spent. You don't want to be invested in the market without listening to that grandmaster, as I call him, with more than 50 years of investment experience. And some of the things he talks about. He has been around the block. But I think hanging your hat on a low forward earnings multiple on some earnings that might or might not, transpire in a year's time is a dangerous exercise. So when people tell me Meta's cheap on 17 times earnings, it's only cheap if those earnings materialize, and it's only cheap if those earnings make its way to me as an investor. And if not, it's not cheap.
Sean, what are your thoughts on Apple and Alphabet as investment propositions following their positive earnings results earlier this week? Do you feel there's space for more pain there?
Justin, look, Alphabet's results were phenomenal. And if there was one tech company that I had to own, and it would be that company. Apple, great results, 11% revenue growth. As I mentioned earlier, it's just, it's going to be hard. Elephants don't gallop. But it is just a massive company, and it's just going to become ever harder and harder for them to grow. So yeah, at least, but certainly Alphabet, I couldn't find a chink in that armor. So that was good.
Amazon's earnings tonight, one feels like the market's at a tipping point. An earnings miss and a gloomy outlook could throw the market off edge. What are you expecting?
Yeah, I think that's a very good point. I'm not expecting, as I mentioned earlier, I'm not expecting good things from Amazon. And I'm amazed that 100% of analysts rate the company a buy. I think you've got wage inflation, you've got steel inflation, you've got fuel. I think people are out shopping a little bit more. I think there's more competition for the advertising budget. So I find it hard to believe. Their content costs have gone up more. So for Amazon Prime, we've seen that with Netflix. So I find it hard to believe that Amazon is going to beat on the upside. And actually, last quarter wasn't so good anyway. So it's rather ironic that, at the same time as Jeff Bezos is unveiling his massive ship that they're busy building, that they have to dismantle some bridge in Holland to get it out. But I wouldn't hold my breath for Amazon's results tonight. And we certainly don't own any.